What if I told you that some of the wealthiest people alive today never actually planned to be wealthy? No 5-year plan, no investment spreadsheet, no mentor whispering secrets in their ear. They just ended up rich. And I know what you're thinking. That sounds like luck. But here's the thing. When you start digging into how it actually happened, you realize it wasn't luck at all. It was something far more interesting and far more accessible to you than you might think. Because what these people stumbled into completely by accident was a set of very specific financial behaviors. Behaviors that quietly, invisibly compounded in the background while they were busy living their lives. And by the time they looked up, they were wealthy. Today, we're going to break down exactly what those behaviors were, and more importantly, how you can start doing them on purpose. Because you don't have to stumble into wealth. You can walk toward it, eyes open. Stay with me, because by the end of this video, the way you think about money is going to be different. I promise you that. Let's start with a man named Ronald Read. Ronald Read was a janitor in Vermont, USA. Before that, he pumped gas at a petrol station. He drove a second-hand car. He wore a coat held together with a safety pin. When he died in 2014 at the age of 92, his colleagues at the hospital where he volunteered had no idea. His neighbors had no idea. Even some of his family had no idea. Ronald Read left behind an estate worth $8 million. He gave $6 million of it to his local library and hospital. Now, the world looked at this story and said, wow, what a lucky man. But Ronald Read wasn't lucky. He was a janitor for most of his life. He didn't inherit money. He didn't win anything. What Ronald Read did was buy shares in companies he understood, businesses he used, businesses he trusted, and he never sold them. He just held. For decades, the S&P 500, which is basically a basket of America's top 500 companies, has returned an average of about 10% per year over the long term. If you invest consistently and leave it alone, compound interest does something almost mathematical. It turns small, patient contributions into enormous wealth over time. Ronald Read didn't have a finance degree. He had patience. And patience, it turns out, is one of the rarest financial assets in the world. Now, here's where it gets really interesting. Because Ronald Read is not a one-off. There's a concept in behavioral finance called accidental wealth accumulation, and researchers have identified it across dozens of case studies. Ordinary people who, through a small cluster of consistent habits, ended up in the top percentile of personal wealth without ever intending to get there. And when you look at what those habits were, they share 3 things in common. Number 1, they spent significantly less than they earned, and they did it automatically. Number 2, they invested the difference in assets that grew over time. Number 3, they did not react emotionally to market movements. That's it. 3 things. But here's the brutal truth. Most people reading personal finance books, watching money content, following investment trends, are failing at all 3. Not because they're not smart, but because no one has shown them how deceptively simple the game actually is. Let's go deeper on each one. Spending less than you earn sounds obvious. Of course, you've heard it 100 times. But obvious and practiced are 2 completely different things. The average household in the United Kingdom spends 97 pence for every pound they earn. In the United States, personal savings rates have hovered around 3 to 5% for most of the past 2 decades, meaning the average American is saving roughly 3 to 5 cents of every dollar. That is not a wealth building margin. That is a survival margin. Now compare that to what financial researchers call the millionaire next door profile, a term made famous by Thomas Stanley's landmark study in the 1990s, where he surveyed over 1,000 American millionaires. What he found shocked the financial world. The majority of millionaires didn't live in big houses. They didn't drive luxury cars. They bought used vehicles, lived in modest neighborhoods, and their neighbors genuinely had no idea they were wealthy. And the single biggest predictor of their net worth wasn't income, it was the gap between what they earned and what they spent. Stanley called people who earned high incomes but had low net worth under accumulators of wealth. and he found them everywhere. Doctors, lawyers, high-level executives, people earning 2, 3, 400,000 a year, who had almost nothing saved because their lifestyle expanded every time their income did. This is called lifestyle inflation, and it is the silent killer of financial futures. Every time you get a raise, every time you land a better job, every time you get a windfall, there's a psychological pull to upgrade. Upgrade the car, upgrade the flat, upgrade the holidays, and a small amount of that is fine. You're allowed to enjoy your money, but the people who end up accidentally wealthy, and the people who intentionally build wealth protect that gap fiercely. They automate it. They set up a standing order. The money moves on payday before they even see it. Out of sight, out of temptation. Behavioral economists call this paying yourself first, and the research is overwhelming. When saving is automatic, people save dramatically more, not because they're more disciplined, but because they've removed the decision entirely. You can't spend what you never see. Now, let's talk about what you do with the gap. This is where most people get paralyzed. The options feel overwhelming. Stocks, bonds, property, ESAs, 401ks, index funds, ETFs, crypto, gold. Everyone has an opinion. Every headline screams something different, and here's the irony. The people who ended up accidentally wealthy mostly ignored all of that noise. Ronald Read bought individual stocks and held them, but most accidental wealth builders didn't even go that far. Many of them simply contributed to workplace pension schemes or government savings programs without thinking about it. And the passive, automatic nature of those contributions is what made them wealthy over 30 or 40 years. Let me give you some numbers. Because numbers make this real, you invest £300 or $300 per month starting at age 25 into a broad index fund returning a historical average of 8% annually. By age 65, you'd have approximately £1 million. That's it. £300 a month. The price of a few meals out, a streaming subscription, maybe a gym membership you're not using. Push that to £500 a month. You're looking at over £1.7 million by retirement. What if you start at 35 instead of 25? That same £300 a month at 8% gives you roughly £440,000 by 65. Still life-changing, but you've lost over £500,000 just by waiting 10 years. That's not meant to make you feel bad if you're starting late. It's meant to make you start today. The single best investment you can make right now is not in a specific stock or a hot asset class. It's in time, starting now, with whatever you have, okay? So we've talked about the gap, and we've talked about where to put the money. Let's talk about the third thing, because this one is where almost everyone falls apart. Not reacting emotionally to market movements. Let me paint you a picture. It's early 2020, COVID hits. Markets around the world crater. The S&P 500 drops 34% in a matter of weeks. Billions of dollars flood out of the stock market as panicking investors sell everything and move to cash. And then the market recovers. Fully, and then some. Within months, the people who sold, they locked in their losses and missed the entire recovery. The people who held, or better yet, kept buying, saw their portfolios not just recover, but hit all-time highs. This pattern has repeated itself throughout financial history. Every single major market crash: the dot-com bubble, the 2008 financial crisis. The COVID crash has eventually been followed by a recovery that reached new highs. Every single time. Now, that's not a guarantee of the future. Past performance doesn't promise future results. I want to be clear about that. But what history does tell us is that the biggest threat to your investment returns isn't the market, it's you. There's a famous statistic from Fidelity Investments, one of the largest asset management firms in the world. They did an internal study to find out which of their customers had the best investment returns. The results were remarkable. The best performing accounts belonged to people who had forgotten they had an account. Literally, people who had opened an account, invested money, and then through forgetfulness, or being too busy, or simply not caring, never touched it again. They outperformed the active investors. The people checking their portfolios daily. The people adjusting, reacting, trying to time the market. The strategy that worked best was the one that required the least human intervention. Let that sink in for a moment. So why don't more people do this? If it's this straightforward, why aren't more people wealthy? 3 reasons. First, delayed gratification is genuinely hard. We are wired, neurologically, to prefer a reward now over a larger reward later. It's not a character flaw, it's evolutionary biology. Our brains were not designed for 40-year compound interest strategies. They were designed to hunt, gather, and survive the immediate moment. Wealth building requires overriding that wiring, and it requires doing it consistently, for years, without much visible feedback. Second, financial literacy is shockingly low, even in wealthy countries. A 2023 study by the OECD found that less than 40% of adults in developed nations could correctly answer basic questions about interest rates, inflation, and diversification. That means the majority of people in the UK and USA are making financial decisions without the foundational knowledge to make them well. And third, and this one might be the most important, we've been sold a different story about wealth. We've been shown wealth as dramatic, sudden, a startup that explodes, a crypto token that goes to the moon, a lucky investment that changes everything overnight. And while those stories exist, they are the exceptions so extreme, they make the news precisely because they are extraordinary. The ordinary path to wealth is boring. It is systematic. It is patient. And it works for people who are willing to commit to something that doesn't feel exciting, because the results come so slowly that they're invisible for years. And then suddenly, they're undeniable. Let me bring in one more story, because this one hits differently. Grace Groner was a secretary at Abbott Laboratories in Illinois. She worked there for 43 years. She never married. She lived in a 1-bedroom cottage. She bought her clothes from rummage sales. People who knew her described her as incredibly generous, warm, and completely uninterested in material things. In 1935, she bought 3 shares of Abbott stock for a total of $180. She never sold them, she just held. And every time the stock paid a dividend, she reinvested it. For 75 years. When Grace Groner died in 2010, those 3 shares through splits, dividends, and compounding had grown into an estate worth $7 million. She left all of it to her college, Lake Forest, to fund student scholarships. Grace Groner wasn't trying to get rich. She was just not spending money she didn't need to spend, and holding assets she didn't need to sell. Her story is almost unbelievable, but the math behind it is completely explainable. It's compound interest. It's time. It's doing nothing. Strategically. So here's what I want you to take away from this. Wealth, real, lasting, sustainable wealth, is not about making the right call on the next hot stock. It's not about timing the market. It's not about having a high income, though that certainly helps if you deploy it wisely. It's about 3 things. Over and over again. Spending less than you earn automatically, systematically, without needing willpower every single day. Investing the difference in diversified, growing assets, and leaving it alone. And protecting your own portfolio from your own emotional reactions, because your brain is going to tell you to do the wrong thing at the wrong time, repeatedly, and your job is to not listen. The people in these stories didn't have secret knowledge. They didn't have special access. They had discipline, patience, and time. And every single one of those things is available to you, right now, today. The question is whether you're going to wait for the perfect moment, which will never come, or whether you're going to start with what you have, where you are. Because here's the truth about your future self. They are going to look back on this exact moment, and they're either going to feel grateful that you started, or they're going to wonder why you waited. Don't make them wait. If this video gave you even one thing you didn't know before, consider subscribing to Beyond Income, because this is what we do here. We take the most important financial ideas in the world, and we make them actually make sense for real people. No jargon, no gatekeeping, just the stuff that actually matters. I'll see you in the next one.